Joining us now. Let's head to the trading floor. We've got Alan Neckman, Chief Market Strategist at Agora Financial. Alan, we kind of wonked out on yields and central bank policy, but let's bring it home to the markets. If the markets are, priced as a multiple of earnings expectations, and let's bring it all back home. And to what extent are the markets pricing in the fact that all of this volatility, all of this trade uncertainty is going to start to hit the bottom line of these companies?
Well, as a trader, volatility is good. We've seen 1% moves almost every day for the last couple of weeks. Let's remember, it was 3 weeks ago today that we made all-time forever highs in stocks. So sentiment shifts very quickly, psychology changes, and that's really what a lot of this is. The action that we saw yesterday was very important because it was a test and reject of those super lows that we had a couple of Mondays ago, and then we had a healthy bounce. So the S&P is approaching the halfway point of this drop from the top, and every time in history, once it gets above that halfway point of that fall, it's rallied back and made new all-time highs. So to get back into earnings season is essentially done, and it came in better than expectations. We had a very low bar to hurdle, and so the growth has slowed, but it looks like the next couple of quarters things are going to pick up again. And let's remember, when it comes to the expectations, companies have beat 75% of the time here this quarter, and the beats have been on average about 5%. That's what the market likes to see, and that's happened.
So it sounds like what you're saying, that this time is not different, and you should be buying the dips.
I don't think so. We've been through a lot of iterations of these sell-offs. Now, this one is super self-inflicted. This one can also be super self-corrected. You talked about the politics and, those issues in the marketplace. But I think the main point of your previous guest was that there is no choice. I mean, what are the choice between treasuries and stocks? There was no choice 6 months ago. There was no choice a year ago. And today there's absolutely zero choice as far as the chase for yield. It doesn't make any sense unless there's an economic catastrophe, which, you have to be very aggressive to make that kind of call at this point. And even a call. Recession is 2 negative quarters of GDP. We're nowhere near that right now. So just on Wednesday, we were 3% before the sell-off on Wednesday. We were 3% away from the all-time highs. So I think it's more of an issue of a lack of faith here. And low interest rates are actually a positive. We're pricing in 3 more rate cuts. We're going to get September, December, and March now. And so that's going to bring our rates down to 1%. So where's that choice? The yield in S&P stocks is greater than that right off the bat, plus the appreciation on any upside moves.
We only have about 60 seconds left, but if you believe that the yield curve will be as reliable as it has been in the past and a recession is coming, but you want to stay invested, does that mean you position more defensively this time rather than that rah-rah pro-cyclical tilt that has really dominated?
I'm still a big believer in buying on dips and buying stocks that have been battered and beaten up. A good example is Facebook is still 15 or 20% off its highs. And I'm an options player. I buy options that have about 6 months of time, in the money options that behave like the stock. So that's the way I play it. And if this market doesn't respond in the next couple of weeks, I'm not out that much time. So that's where my focus is right now, and I'm still looking to see this market bounce back. 29.25 is the number, the halfway number in the S&P. We get back above that, then we should be marching on the highs, and you can see how quickly, when the market gets squeezed, the shorts get squeezed, we've snapped back, and that's happened every time in history until it doesn't.
All right, Alan, thank you so much for joining us.